Right. Thanks, Rich. And as usual, these two presentations, I'll be talking more practical things on looking at implementing a plan, and then Dan will be giving us some great outlook information that can help us then decide on where we want to go with that plan. And so I always like to start out with this one here. To be effective, any marketing plan, it needs pricing increments, price targets, and date targets. So once you get that plan put together, it's got to have all those things. And then those tools can help you lead to better action, we hope. The other thing is, I'm going to be running through samples. I'm going to say, here's our sample winning the game plan. Here's how it's coming along. Basically, these are not advice, but really, I'd like to think that they are benchmarks, something that you can compare. Okay, you're doing this. There's Mark saying this. How do they compare? Are you doing better, doing worse? Where should we go? When you register for this workshop, there's always a question, right? And one of the questions, I got to figure out how to get it to move now. One of the questions was, when will be the best time to sell my 2024 wheat? And so that's something we've been kind of talking about, really starting that discussion as early as April. And, as we've worked our winning the game plan, the thing we kind of came up with was, forward contracting 30% prior or into harvest. And then at that point, we said, hey, let's sell all those uncontracted bushels. So basically, I'd say, to answer that question, my 2 cents is maybe consider selling all of that here pretty quick. On June 28th, we implemented in our plan what I call a March call spread. We bought a 620 call option and we sold a 670 call option, which helped reduce our overall cost on about 50% of the production. That was kind of the recommendation we had. And basically, we got into that position then that the maximum we would lose is 18 cents. So kind of consider that our storage cost. So again, what that did was it gave us an opportunity. We sold the cash crop and we said, we're going to get on here and we're going to use calls to take advantage of any price rises. So that's kind of was the plan that we're implementing. And at this point, cut to the chase, I still think maybe that's not a bad plan. One thing we looked at was this chart, right? This is the 15-year Kansas wheat price versus storage cost, sort of a little thing. And what we use are the monthly prices from NASS. And so the way to look at that July price of $5.75, that is the 15-year average of, according to NASS, for the state of Kansas. And then each blue square after that represents that 15-year square, or that 15-year average price. Now, the other lines, the green lines, would represent an on-farm example, high and low interest, and the orange lines represent commercial storage, high and low interest. And I kind of got the details put in there. But what they represent that's the price you need to break even with storing it unhedged. And so basically the chart says, well, yes, there's been years, maybe it has, because that's just the average. On average, it does not pay much to store. Maybe if you hang on till May, yeah, you're making a little bit of money if it was on farm. But that's a tough gamble. And the other thing we were always doing, though, we were looking at this kind of an analysis. And I redid this for last Friday. But basically what it outlines is four I'd call it alternative actions you could take. One is sell the grain and be done, right? Just sell the grain and be done. Last Friday in Salina, this is a Salina example, local cash price was $5.15. Now, I know that's high. Right now, I checked this morning, it's like $5.16. But I know as you go west, we're seeing prices ranging from $5.16, or let's see here, wheat as low as $4.69. So a person would have to put in your own numbers for this analysis. But I think in general, from a decision-making standpoint, this holds a little bit. I'm going to start over here on the right side, the white part, where we're saying, hey, let's store it. Now, this is a on-farm storage example. I'm looking at March futures, and I'm saying, let's store it for 5.5 months. So get us into about the middle of January. Okay, so my expected basis then is 20 cents under. That's that in bold minus 20. Current basis at 5.48 futures and a 5.15 price, we're seeing 33 cents. So we expect that, basis is 33 cents under. We think it's going to be 20. So we're going to see a little bit of basis appreciation, we think 13 cents. But I've got to pay for my storage. And interest at 5%. on that value of 515 would be about 12 cents, right? 11.8 cents. And then we use sort of a 1% shrink on the value of that wheat plus a 5 cent in and out charge, which is basically you pay right away on farm. So that's 10.2 cents. So we're looking at roughly 22 cents. I think that is, yes. 22 cents in stores to get us there. So we're going to see 13 cents in increase in basis, but that's not going to cover our storage. So basically, if we would hedge, right, we'd need to sell March futures at 548. This suggests when we throw all that together, basically a 505 expected price, which is a couple cents better, but I'd largely call that a break even. And if your grain right now is in commercial, you haven't quite maybe incurred 12-cent storage, which I'm showing here in the on-farm. So to me, storage is sort of a break-even thing. It's going to take a pretty good little increase in cash prices and a more than average increase in basis to really make storage work post-harvest. The other two things I'm looking at is sell the grain and buy a call option. Call option of 550 at the money strike. That'd be a March call option, was 36 cents under, or 36 cents, which puts my minimum, right? My minimum, they're 466, which, man, that's a big hit. So the one I usually like to kind of consider is selling that grain, and then it's a bull call spread according to CME, but basically what we're doing is we're buying that at the money call 550. So we're spending 36 cents, but then we're turning around and we're selling a $6 call, March call, and we're getting 20 cents. So I'm spending 36, I'm getting 20 back. I'm in that position for 16 cents. Kind of figure a penny for hedge costs on both sides of that. That's another, so I'm in there for 18 cents. That's where we would be Friday. That's exactly where we were back in June 28th when we did it. It was 18 cents you could get into that position. Slightly different futures prices and call option strike prices, but the net effect is the same as far as what you're getting into. Again, the way, let me show you how that might work. I'm going to throw that up here. I'll go to the next slide. Here's where my futures are. Again, our plan is we sold all uncontracted bushels at harvest, and we implemented that March call. Since May, that high we saw up in the 780s, we had the high that day, 780. Since that time, futures have dropped to 28. And what we can do is kind of say, okay, what if we would see a rally in prices? Sorry about that. Let me throw this in. Here's the March call spread. We're basically buying a 550 call, selling a $6. And the way that works then is you look at that green arrow from at the bottom of that, that's about 568. We make money all the way up to $6 futures. So if we would see futures and they were like about 548, if we'd see things go up to about $6, I'm making money. When we got to get up to 568 first, that's where I break even. After 568 up to $6, I'm making money. After $6, my two option positions wash. And so that's why it's gray line beyond that. So if we'd see a 720 rally in prices, I'm not going to get any of that. All I get is that little portion in green, about 32 cents if we can get up to $6 futures. I think that's pretty good. I don't know if there's that much bullishness in this market. And at this point, that's where it kind of comes down to your outlook. Where do you think prices are going to go? And kind of leave that up to Dan to maybe give us more. But if we've got room for, say, a 50, 60 cent rally up to $6, that may not be a bad thing for you to take a look at. The other point I want to bring out here is that, when we think about our, storage costs, right? If we implement that March call spread, right, and I'm buying a 550 call, selling a $6 call, getting rid of the cash crop, I'm in it for 18 cents. So that's my storage costs. On-farm storage, using our numbers, for up through December, it'd be 21 cents. Off-farm, if we're looking at, say, 6 cents commercial storage plus our interest, you're in there about 41 cents. So, the call spread is kind of a cheaper way of re-owning, so to speak, but you're doing that on the board using March futures, March calls. I do want to point out something we could do is just buy futures. But that's highly risky, and that's why I don't think you'll ever see Dan or me say that's something we should do. And if I'd have done that June 28th, that position would be down 68 cents. And I want to say I had that calculated. So I would be down about $3,500. Currently, that June 28th position I took, 620 and 670, got into it for 18 cents. I could get out of it for a loss of 9 cents or $450. So that's kind of the difference when we use a call, these option strategies versus say just straight going into futures. Now you'll make a lot more if futures go the way you want, but when it doesn't, like I say, June 28th, when I implemented that call option, if I'd have bought futures, I'd be down 68 cents. So a much more risky thing to do. So I'm going to stop there. That's my side of answering that question. What should I be doing with my 2024 wheat crop? Let's take a look at that sample pre-harvest 2024 feed grain plan. We've had this out there since January. We had very aggressive price targets. We haven't hit those. Also, I was using $5 as my minimum futures price, and we've never seen that since January, right? The one thing I do want to point out, and I think I showed this last month too, was that in these bad years where we don't see any kind of price action, we just see prices drifting down all growing season, we do a lot of times see at the end of, say, get into September, we start seeing a rally into what I would consider October, and it's kind of when we're, the height of our Kansas corn harvest. So I'm hoping, just history says we may have a good shot. Do you want to tie into what Dan says, though, on where the fundamentals are showing? But history would say we got a shot that we may see prices actually trickle up as we go into harvest. So again, I haven't done much, right? If I look at my plan, where am I at? I'm 10% priced. Now, I did that at 491. At hindsight, that sounds very good. For all the guys out there, guys and gals that have done better than that, raise your hand, tap yourself on the back, great job. Because if we'd have been selling back then when futures were 490, we'd all be thinking we're brilliant. Because since then, we've seen a $1.07 price decline, right? We got 10%. At that time, I was hoping to do the other half of that to get me to 20% price if we could see a rally up to 520. Well, we never saw that. So I'm still wanting to price, not seeing any opportunities. It's just a tough thing. I guess at this point, my hope is that history would say we've got a shot at a bit of a rally as we move forward. So that might create some opportunities. A tool we talked about last month, I'll throw it up here again, is, we see how that $1.07 drop in prices from the high that we saw in May to where we are currently. And again, I think we traded that contract now down about 385, so our low is even lower now. But what you can do is say, at that time when I ran it Friday, $1.07, what is 33% of that? Add that 33% to the 390, and that puts me at about 425, which is kind of nice because that's also a place that we got back up to in July. So if we could see this little slow drift rally, something kind of, some struggles as we go through September, October, if we can hit that, to me, that was going to be a pretty good price target. Is that where I want to be? No. At this point, I think I would be covering my direct costs, those out-of-pocket, those variable type costs, also plus maybe any cash rent if I'm a cash renter. A 50% rally would be up there about 445, and a 67% rally, which would be a pretty strong rally at this point, is getting up there over 460. But again, I think would I be pricing another 10-20% if I could get back up to that 425. Same kind of thing on the soybeans. We haven't done much. We've actually proceeded according to plan on that. Again, we also see a bit of a trend back up into harvest time. So I'm hoping we see that. Hopefully history repeats itself. Here's where we are in the November futures chart. We did a little bit in May. We did a little bit in June. Again, we were well above our costs. We were well above our target. So we were doing that. We were hoping for much higher prices. We aren't seeing them. At this point now, we're down below that $11, although we are probably still at a point, especially if we see that kind of a rally. If we could get back up over 1040, I think we would be covering our direct and maybe even our direct plus cash rent. So that's at least getting something out of it. And that may be about as good as we can get. Again, we want to turn our attention to kind of what Dan thinks on where, our opportunities are here in the short run over the next, say, 2 months, and then also extended. The next thing I want to do is kind of just pivot a little bit. Something we've been working on is kind of get a better handle on what production costs are. And so what this reflects is 2024, I'm going to call it winning the game production cost estimates. What it is basically, I call it a Kansas estimate. It includes irrigated, it includes non-irrigated, and what we're using are all those KSU Ag Economics farm management guides. And what we did was we tried to apportion the percentage of Kansas acres in each of those slash practices that are being used in areas of the state. So we're hoping this is sort of a weighted average price cost estimate for Kansas. Okay, so we're looking at 385 direct. You see that asterisk direct with cash rent. A lot of producers rent a lot of cash ground and they're paying cash rent. And so while, if you own all your land, sometimes you can get by not paying yourself, right? If I'm one of those younger producers, if I have a lot of cash rent ground, I need to throw that in there as a cost. And so I throw that in there too, just as a target. So to look at the wheat, 59 bushels is our goal. That's not a state average. But again, as farmers, we're farming for 59. Direct costs, which is, all those out-of-pocket costs, crop consulting, additional labor, crop insurance, custom operations, diesel, fertilizer, fungicides, herbicides, etc., is $3.85 a bushel. With cash rent, puts it up to $5.40. So that's kind of that. I got to get that to cover my costs. $6.68 would be my total. Now, what I've done, because these budgets come out every November, what I did was I said, let's take those costs and adjust direct costs up, say 4%, fixed costs up 3%, because what that then gives me is some estimates for 2025. Because I think it's time that we all start looking at, well, what's happening back in 2025. So 2025 crop corn, we haven't even planted it, right? 2025 wheat, we haven't planted it. I think we should start looking at those though too. I've also then taken this a little further. I took those costs and I created sort of a July futures target. 455 would give me my direct cost. 616 would give me my direct cost with cash rent. And 747 would be a July 2025 target, July futures target for total costs. Now, obviously, these costs I throw together are meaningless, right? They're meaningless. The key is what are your costs, right? So that's why we've got that in there. Again, this is, I think, about my final one I want to show here, but this is sort of the long 25-year test. And my concern is, should we be looking, July hard red winter wheat futures for 2025 were about 560 on Friday. I think they were trading about that again still today. My direct costs are 455, 660, July target of 616. So I could at least at 560 get my 455. So here's where we are now. If we could jump that thing up to 620, I think that's a great opportunity that maybe we take some action, because there is a very good chance if these more bearish fundamentals continue to hold, and I don't know where people are at, we need to listen to what Dan says, but there's a chance, heck, by 2025 harvest, what if we're down here at 450? At 560 futures will look pretty good right now. So with that, I'm going to say thank you, and we'll take a look at the questions, and I look forward to hearing what Dan's got to say as far as where fundamentals are moving this market.
Thank you very much, folks. Mark, really appreciate your work there, and especially the work on cost of production issues. We'll see where numbers go. The only thing I could think that might be a challenge on the inflation front would be I think some uncertainty about where fertilizer prices are. If we plugged in high fertilizer prices in last year's budgets, which I think we did, we may have a little bit of relief on the cost side there, but that might be the only thing. So, well, I appreciate the chance to speak with you. Let's see here, and like to talk about or try to address this issue of the seasonality of lows in the corn, hard red winter wheat, and soybean markets, in particular over the last handful of years, and see if there's anything there for us to give us some perspective on our current situation that we're looking at with low prices. Of course, the closed on in the corn market at 390, 391 for this is a monthly chart. And as you start looking at different years, 2013 on, and try to see when the lows came, that might give us some perspective. So you look at the 2013 calendar year, dealing with pretty much the 2013 crop, or looking, you had a lot of new of supply perspective, supply potential perspective. So November 13, 415 and a half was the low on a monthly basis for the year October. And in 2014, October 318, November 356 in 2015, 2016, August. And you can see in that particular year, we had a low and then some crop problems coming into play. And 2017, we had a low in November, in a harvest low, a little bit earlier, coming into harvest low in 2018 is September 342 and a half, September 19 352 low, and then in 2020 again we had started to see health issues, other international challenges coming into play during these coming years. But in an upward year, it dropped off down to a 309 low in April 2020. After a run up, we had a low again in September of 497. We had gotten up to about 740, 730 thereabouts. Another in 2022 had jumped higher with production uncertainty and Ukraine, Russia, all manner of things in play, but did have a low then of 561, 562 in July, and November of 23, a low of 461, and are now wondering, are we seeing a low now? There does seem to be in years where we aren't dealing with drought or geopolitical issues or whatever, that we have tended to see these fall lows somewhere September, October, November. And I did want to show you where the latest situation we have in terms of futures trade. This is looking specifically at managed money traders, i.e. specs, and looking at their long positions and their short positions. So you see the red, this is in terms of millions of bushels, so 1,000, and so this over here would be 1 billion bushels, and 2 and 3. So we had the record short position since for speculators since June 2006, back here in 2018, 2019, 2.65 billion bushels. We're not quite at that, but we're pretty bearish. If anything, you could say we've gotten bearish and we've sustained it all that much more than this pretty herky jerky motion that we had here. And you can see that when we've been long, had more longish positions, 2021, you can see the price run-ups when we have stronger longs, the price declining when we have more short positions. So these are Tuesday closes. So to match the days when we get the CFTC data. So 375 is the low, and you can see the bearish position of the market. So so Mark, going forward, that'll be if we have a change in the market, you'll have to change the information set and that traders are looking at and their perspective. Right now, their money is where their perspective is, and they're pretty bearish. Soybeans, you can see again, October 2014 was low 904, November 15 844, September 16 934, June 2019 again a little more of an upward trend, weather, other issues in play, and September 18 812, May 2019, 791 low. April 2020, 818. Of course, with soybeans, you have all that much more influence from South America. In particular, Brazilian soybean production, Argentina to a degree, Paraguay in play. And November 21 low of about 1181, 1288 July of 2022, June 2023, 1202, and now again our latest number 973, definitely down here in the area in the range where we're not dealing with you know 12, 14, $16 plus soybeans. We're down more in more of a moderate world stock situation, U.S. and world stock situation, and a little bit lower prices. And we do well, and differently than for corn, we have here recently had a recent record bearish position for sold managed money spec traders, 1.2 billion bushels, 1.22 billion. Again, 2019, we'd gotten pretty bearish. Interesting, when we got down to this area before this bearish, we had an 822 price. When we get now we're at 957. And just go back one bit here. For corn, when we were short before, we were at 353, 303 wasn't far behind. Now we're at 375. So Mark, that might be, it's probably an indication, something of inflation and supply demand break evens if impacting the market. For hard red river wheat, low of 550 in 2014. This is a continuous monthly chart. November 455 low in 2015, August 395 low in 16, 381 low in September of 19, 420 low in January 2018. Again, different market issues coming into play. 381 low in September 19, 409, about 410 in August 20, March 21, 553. And again, the other issues coming into play, whether it be a Black Sea region, all of that. August low, 808 and a half in 22, 23, 595 low. And at that time, we look at that almost with disdain in kind of a behavioral science view, given what we'd been seeing. But now 595 looks pretty good. And again, that question that we're 534 and a half, or we were as of Friday, and again, you can see any of this risk and uncertainty that we were looking at, any worries in the market all the way through 2021, 22, and 23. We've pretty much done away with that. And you can see the bearishness of spec traders in the wheat market. Not quite the record that we'd seen back in 17 and in 2019. Interesting again. So here we're pretty bearish. You can see the depth to which we are. 546. We were bearish before. We were at about 380, something like that. So again, as we sit right now, perhaps it's inflation. Not sure, but when we get to into these bearish realms on traders' opinion of the market, we certainly see price lows, but there is a bit of a drift to the higher side. Let's take a look at weather. Even though most of the outlook, well, I guess we've had an interesting path throughout this summer. After plantings, we generally stood in pretty well. Had decent through May, June, etc. Pretty good weather. There was a change in the outlook for La Nina versus, well, El Nino as a transfer back to La Nina, and we had strong opinions, strong assertions that gosh, things were going to turn really hot and dry in the latter half of the summer. So that helped us support grain prices, but that really didn't materialize. And and it's difficult to make either weather or economic forecasts. Let's just put it that way. We did have a little bit of hot, dry weather for about a week or so, but it didn't sustain. And so we've ended up in this situation where we in Iowa, southern Minnesota, Wisconsin, Michigan, and parts of South Dakota. You can see up in here, wet conditions. And in terms of the short-term drought composite indicator, green and blue, indicating quite a bit of soil moisture. Kind of a mixed bag in Kansas, pretty dry conditions. Ohio, off in the West Virginia, and so you can see some mixed effects in Indiana, Illinois, generally pretty good. So when crop tours have gone out, they've come in and showed strong yields in these areas. Have actually myself driven through up in this, I guess from down here in Kansas up through Nebraska, northern Iowa, southern Minnesota, etc. And the corn looked mixed and spotty. And I think the Pro Farmer tour that just came through there indicated some of that. Again, pretty good corn, but not tremendous, but yet great yields coming through these areas. We shall see. And I think it's worthwhile to watch what the weather has done over the last 90, 30, 14, and 7 days. So last 90 days, really, you can see by the scale over here that where we tend to have more moisture, where things have been dry at. Last 90 days, pretty good average crop production weather. The last 30 days, a little drier in some of these areas. We saw that previous map, still wet in some of them, but starting to dry out a bit in parts of the 3 I states, Missouri especially, Southwest, Kansas, parts of Nebraska, most of eastern Nebraska, the crop production areas. Last 14 days, you can see a little drier, particularly to the west, drying out some in those areas to the north. The last 7 days, really dry. And article out of DTN this morning from long-term climatologist. Let's see. There we go. Right, long-term climatologist in our Ag Weather Forum. A late August heat wave may reduce crop yield. So we have that uncertainty. I think right now it's probably more along the lines of just hand wringing, but there is hot, dry conditions could affect the latter part of crop maturation. Again, that Pro Farmer tour came out, projected 181.1 bushels per acre, and I think 53.5 to 54 or more bushels per acre for soybeans. Again, the general consensus out of that is that gracious, soybeans look good, and corn looks pretty good. Forecast through the end of September, given the information in hand right now, is for dryness in some of these areas. Of course, if they're really wet, to actually have a little dryness may be a benefit. But in general, you can see the lagged average of soil moisture outlook through to get us to the front end of harvest in most of the Corn Belt, and you can see generally thought to be drier. I did want to show this international map of again calculated soil moisture ranking percentiles through these key areas of the world for crop production. Pardon me. And again, the here in north, we have some of our dry areas that we're concerned about. You can see more so down in Mexico to the south, and still it's interesting to me to see that yes, we have great crop production forecasts out of Brazil, but they continually show dryness on their maps. It's just interesting. So that really that affected some of their crop production this year, but now they're just about to turn the corner and start planting crops, seeding crops in parts of that continent, and we'll see what potential for dry weather does there. Note up here that in the Black Sea region, this is particularly of note for for the wheat markets, evidence of dryness, some I guess from the USDA numbers that are projected, probably more a foreign ag service focus, you do see some impact on their production. And really, that this is a weather map. I think that when we start looking at the wheat market, we're probably as concerned about geopolitical issues, heightened tensions in the Middle East, Israel, Iran, challenges because of dry weather, and really ongoing conflict. If anything, as we look at it now more with recent incursions, recent actions by Ukraine, almost more of an unsettled situation than we've had for a good while. So Mark, when we talk about what would happen in the wheat market, if we just look at supply demand estimates, it's probably a pretty level situation. There's not much that you can see of there, absent a disruption out of the Black Sea region and geopolitical issues happening elsewhere in the world that would roil the financial markets, bleed over to the commodities. But then again, from my position in Kansas State, I'm talking about I can speak towards grain market supply demand issues, and these other issues that could impact us are kind of we looked at it almost almost as a speculative deal. It's really outside the realm of what I can comment on, other than to know other than to state, it seems like the uncertainty that can come into the grain markets from that is more so now than it was in the past, and it's just a question for us to think on. If those geopolitical extra ag impacts come into play, where does that put us in terms of our pretty conservative outlook? South Africa, they have an importance, particularly for corn and some other crops. Not a lot of dryness in India, in China, at least right now that we're looking at. And again, Australia generally doing better for sure than they were in the past, but not major issues to look at least at this time. So let's take a look at feed grain markets. I'm trying to move quickly. For CME corn futures, so DEES is the new crop contract, 391 on Friday's close, and we've certainly dropped off. We have that negative carry is from the close of the July contract. Last close, straight on, dead on, $4. Dropped 368. You can see the average loss 16 cents and a little bit of a few pennies on the drop there. But once you get into harvest, then you're asking the question about storage thereafter. And just the psychological question you'd ask ourselves: are we willing to look at 391 and to either hedge that for a forward contract situation, or if it stays 391, is basically 29 cents return to storage minus costs and accounting for basis? Are we satisfied with that? That's a question for us to think on. I would say that you look at the pattern of prices. Here you come in and look what's happened in June, July, August. Yeah, the prices have dropped off. That's this brown line here, and that's in the current 23-24 marketing year. That'll end August 31st here, coming up in a few days. But then we roll over to what the futures are telling us for the new crop marketing year, starting pretty low in the red to get September, October. And so basically the futures are showing some seasonality, some carry, but and arguably not enough to quibble about in terms of the normal seasonal price at superimposing Kansas prices on that. If anything, probably underestimating the type of risk we normally see out in the summer. And again, you can see the high and low of all this. This purplish line, gradation. There you go. Line shows the average. You've got a lot of volatility. all this volatility not accounted for upside or downside really, but we're talking about years in which we don't have crops in the ground yet. And I just did want to take a quick look at prices. Corn prices, strongest price still, Garden City area, demand center for the state, 60 over basis. Hutchinson, 38 over. Also pretty strong area. You got some ethanol plants and some other usage going on there. Export oriented area. New crop bids 416, 369 in those areas. So Mark, as you were showing before, those new crop bids at this time would be, I think they're less than the break evens you were putting up there. So basically we're hovering around $4, and for corn we're covering direct costs, hopefully getting at some of cash rents, but in a year like that, what aren't you covering? You're not covering machinery. And if your family living's beyond that, then you're not covering that either. So your hope is to have great bushels, lots of great yields, lots of bushels, and for that to help you out. For grain sorghum, the grain sorghum basis bids early on when we had stronger exports, they were premium to the basis bids for corn. But as grain sorghum exports have slowed, so as their competitive position with cash corn bids. Again, strongest cash bids and basis for grain sorghum in Salina, Hutchinson. Colby bid is pretty good, not too bad. Topeka and new crop bids 371, 368, 381 tops. So not a lot going on there. And just wanted to show, so we have seen a little bit of our normal basis improvement in the western part of the state, using Dodge City as an example, and central part of the state and using Salina. We haven't seen any of that in the eastern part of the state. I kind of look at this as a secret, as a signal of whether are we tight, for supplies in the summer heading into the next year. And so we're a little bit tight in terms of what the elevators are bidding, but we're not showing, even as futures have come down, that the basis bids have gone strongly higher out in these western central Kansas areas because of us being short. There's just no signal of that. We did through the summer, through these last few months here, of a feedlot or such being caught short real quickly, and they would go directly to producers and give strong bids like 70 over or something like that. But that's more the exception than the rule in general, at least as I understand it. Just a note, strongest bids in the nation for ethanol plants come out of Kansas. You can see the range of bids 383, 418, and the average 405, and there's really no other place. There are other places that have some pretty good top end bids, but on average, Kansas has strongest ethanol plant set of bids of anywhere. So corn yields, you can see the 181.3 bushels per acre, the latest USDA number. That that number had been 181. It was a trend line yield, World Ag Board. I think here we're coming into the time period around September 1. We'll have the objective yields from USDA NASS that'll supplement the farmer surveys we had for August. So I just think that'll be really valuable to have. So anyway, that's where we stand. You can see even from 2007 to 2024 that per year we're gaining, but we're seeing a trend line yield of about 2 bushels per acre gain all the way through there. And this year probably merits optimism. Here we're 2024, pretty good moisture in a lot of the corn belt, percent good to excellent, going sideways now. So the issue for us on these yields will be with hot, dry weather forecast. Will that sideways trend for percent good to excellent hold up? If we do, then the 181, 183, 180, whatever, probably within reach. But if so much depends on the weather finishing all of this out. And so the U.S. corn production forecast, and I've already tipped my hand. I thinking that the latest WASDE number probably is high, particularly when you see the forecast drier weather and looking at some of the independent surveys that have been out there. So about a 1/3 chance, a little bit more, that the USDA's 181.3 stands up, and that's my own. I take responsibility for that. That's my own thought. And the corn usage been pretty good. Don't see anything falling off. Probably some question about feed usage and then next year's, given livestock numbers on beef on feed, etc. We'll see where that goes. But as of now, really usage holding up decently. Ethanol plants profitable with cheap corn and so-so ethanol prices. So this is the latest situation for corn. You can see the gain in stocks to use from 8.3% up to this year projected just under 14, price of 420. The last time we were around here, 13.9 was back in 2019-20 or 13.7. We were looking at, we had a price 356. This year we're just slightly higher than that, and even higher than that number, and we're looking at a price at this time what we anticipate about 420. So again, Mark, some inflation seeming to be in hand. And so I would say then for corn, this is the USDA's projection, and nothing wrong with that. Again, I just would seem that for the factors already stated, the 181.3 was a little bit high. If we go back basically to the July numbers, the 181, which would still be a record by I think 3.7 bushels, and you'd be at you'd take off about 176 million bushels. If everything else stayed the same, still a lot of corn, same usage anticipated, you'd be at 1.9 billion bushels and about 12.7% stocks to use. And if you look at stocks to use versus price relationships, that's a little bit higher corn price, about 420. Pretty plain. The futures, when you figure out what the futures are forecasting for new crop prices, about 419. So I'm saying, in my thinking, it's about a higher likelihood of that happening. Still a tremendous yield, 50% chance of that, about 35% chance that the 183 holds up, and then that would leave some chance of something a lot lower. Derechos, really surprisingly hot weather, more damage than we thought, to get you out into these areas. 15%, 3 out of 20. Look at that, and then you're getting closer to 1.75, 1.6 bushels carry out, and still decent stocks to use, but higher prices. So, and I just wanted to show this. So this is really the I'm looking here at the recent price relationships. This is a percent stocks to use for corn. U.S. average corn price, not adjusted for inflationary numbers, just raw price. Generally, you're coming from 2023 at 654, 9.9% stocks to use. 2023, 24, 12.6, 465. We up the stocks to use again to 13.9 about, and it gets down to 420, so you can see the relationships that's there. And if we start scaling back these numbers, then we're kind of retracing this relationship and going back up that way. We shall see. In the interest of time, I'm going to move on here. Let's just want to take one quick, just a comment on sorghum. You can see the strength that we had in grain sorghum sales. The pace is pretty strong through the first part of the year, then began to slow down and is moving towards a decent year, but not an exemplary year to hold things differently. Wheat markets. So just to say what needs to be said, I guess July went off at 604. 520 was a September futures contract number here on Friday's close. And by the way, we're just about to enter into delivery for that September contract. And the carry then, and so Mark, this would come back to what you're talking about. So we're just sitting at 520 in September, 535, about 5 cents a bushel through October, November, December. That's again 15 cents divided by 3. From 535 to 548, 4.4 cents a bushel, and then 556 in May. So Mark, when you look at that, how do you respond to that in terms of wheat storage as you were talking about before?
Well, I guess I'd probably say that it just kind of solidifies the thought that I had that making storage of that physical commodity pretty tough. You look at that and you say, well, 4.4 cents, like I say, we're looking at commercial storage at 6 cents a month.
Yeah.
And so, that's why, I kind of would suggest people consider, again, I don't want to give advice, but my 2 cents would be, I don't want to really hang on to that physical commodity. Is that fair to say? And I think to your point, while we might see a little bit of a bump here, the longer run fundamentals aren't incredibly positive, although anything can happen. But I mean, do we really want to hang on to wheat because maybe, quote, anything might happen? And that's where maybe that call spread can get you into a position to maybe grab a nice little rally. Like I say, up from 548 where March is up to $6. Kind of grab that little bit of a rally there. And I mean, to me, I guess I'll throw that back to you. Is that maybe one of the, and again, not that we want to give advice and say, here's what people should be doing, but is that sort of a low risk strategy, re-own that with a call option?
Well, that's something to consider. I guess following, I've heard people answer a question that they didn't know how to answer best or didn't want to by answering another question. So this is how I'd respond to it. So the supply demand fundamentals don't seem to, as they sit right now, given our information set, they don't seem to give us guidance to hold wheat. Again, these costs are, we quoted the commercial costs, we're not even paying interest on that yet, for money that we could have sold the wheat for in hand and canceled other interest, opportunity cost. So if they do hold that, then they're the best possibility of their gain is probably from these other non-supply demand. Right now we call them, they become supply demand factors if they go forth, but they're more geopolitical and they're having to do with volatility and unrest. So happening elsewhere that affects some primarily important places, Black Sea region. And so that's how I'd answer that. To buy a call, we have to have the conviction that to spend the 10, 15, 20 cents for the call is worth, as a down payment, is worth the potential for the dollar or so going forward. And that's kind of depends on how you're put together risk reward wise for an attitude. Let's go on. Again, the normal seasonal pattern for wheat for a market year running June 1 to the end of May would be to come out of July, September. And really, Mark, this is right on with what you're saying. We tend to see on average in Kansas a sideways wheat market, a little bit of gain after the first of the year. And out here is that volatility that could come domestically from our own production problems. But right now that you've got pretty much a sideways seasonal pattern with a little bit of increase that we'd have to be betting against. But as soon as we say that, we're probably doing everything we can to make the opposite happen. But that's how we'd look at this objectively right now. And cash prices, again, Hutchinson best prices right now, 530, 10 cent over cash price, 526, 35 under for deferred 2000. Actually, that's a 2025 forward contract price. I need to change my wording down below. And you do see this would be for 2025, 521 bids out in Salina and Topeka. So again, below the cost of production unless we just get really great yields, and that's possible. Basis, pretty just a little bit of a surprise. We have seen in the last week or so some pretty strong hard red winter wheat base export numbers. So that's a great thing. Dodge City, Western Kansas, not much movement in terms of basis, but a little stronger basis than a little bit contra-seasonal. And in Salina, Topeka, basis bid doing decently, so it's something to watch. With lower prices, it's a fair question. Have we priced ourselves low enough to be more competitive, given the exchange rate disadvantage we have with other international sources? So the evidence is there. You've got a little bit stronger basis to deal with wheat wise. Not a lot, but something that helps. What will people do for planted acreage this year? If they look at the profitability estimates on wheat, it's probably discouraging. We still plant quite a bit of hard red winter wheat in our cropping systems out here in the drought-prone Western Plains, so that will tend to be a positive there. But again, right now, unless something happens between now and October, we'll have good people that are very good at wheat production making a decision what to do, and they'll probably plant towards their comparative advantage, which is wheat. But it's not like we have $8 wheat that's going to draw a bunch of acres away from other uses. And you can see this in the handout that you got. A little bit of a recovery now on hard red winter wheat, 776 million bushels projected. You can see the other sources. Exports, we had a really rough year for hard red winter wheat. Competition with wheat from the Black Sea region coming in, some of it coming into the U.S. has largely been thought to be a main issue there, but anticipation of a recovery. And you can see the supply demand trends over time, some weakness in U.S. wheat exports over time. Stocks to use at 42% stocks to use, 570 projected price, again coming down off of highs. And so here's the USDA projection, and I would give the USDA their due in this. They're probably right. 2/3 chance of that we can't come up with anything better than they're thinking on that. 42% stocks to use, 570. Futures numbers, by the time we crank them, they're pretty conservative, about 515. Then you do have the possibility of exports going either way. Here a little weaker exports just because of the weakness we've seen in the market. It's my own probability, about 1 in 5 chance, and then about a 50% probability that these issues overseas that I'm wringing my hands over, well, they result in higher U.S. wheat exports. If that's the case, well, again, you take a 39% stocks to use, you put it on there, and then you're getting, instead of down here, you're working your way back up into these 650, 675, something like that. But so it is as it is. Seth Meyer came and spoke at our Risk and Profit Conference on the 15th and 16th of August, and said basically the wheat market confused him, and we agreed, and he explained why. Because again, this long-term continued decline that we see in stocks to use. You can see the differential between what the world less China's stocks are, what the Chinese numbers are. So we pay a lot of attention to the world minus China numbers, and it just seems like that sometime somewhere out there, some issue will come in and spark a lot of volatility in the wheat market. When it happens, if and when that happens, we'll look back and say, gosh, we could see it coming, but how do you act on it when the whole market is pricing like there's no problem? So we'll see where this goes in the longer run. And Russia, Ukraine, you can see some declines there. And we'll move quickly. Finished up soybeans. So we got Again, closed the July contract 1135, just about to close the, well, August contract closed at 980. Whereas September, price off September futures, that's going to enter into delivery here pretty quick. You can see some real negative carries, especially from July to August. But then November 973, November 973, July 1033, 60 cents. So Mark, we haven't started talking about post-harvest yet, but you know, 60 cents. That's something to consider in terms of returns to storage. And note, look at the carries. Again, this is into harvest. Less someone would, well, possibility of if you got that harvest at that time and we don't go lower there, then there's possibility of getting some money there. But 9 cents, almost 8 cents, 7.5 cents, 5.5. Interesting to see the carries in the soybean markets. And again, those are competing pretty well. Every one of them is better than commercial storage at 6 cents a bushel until you get way out into June. Mark, comment on that?
Initially, here's what I'm going to say, I guess. Yeah, we will look closer at that, probably starting with corn next month. But you're absolutely right. That's getting closer. Now, I think some folks, some elevators commercially are maybe closer to 7 cents, you know, on the monthly storage cost. And of course, you know, you're going to have interest on top of that. So, but again, you know, historically, and we'll show that, I think maybe I've got it in my handout. I didn't go through it, but, you know, soybeans are a crop that when you look at our seasonal prices, right? You know, here's that 15-year average and just projecting out those various costs. On average, it does give you a return to storage. So that's definitely a crop that you know, yeah, as we start moving into post-harvest, that may be a crop we want to look at very hard as being the one I stick in the bin, unless I need to be feeding my feed grains, obviously.
Yeah, the world is changing. We're talking about not storing corn now and storing soybeans instead. You know, we normally have tended to move that quicker. And when we store coming out of October harvest, you've got uncertainty on soybean production in South America lasting through January, February. So that has tended to give us some benefit. So there's seasonality as you can see, and 1004 is projected by the futures right now. That's basically taking the futures carry through the contracts using a current basis. USDA is forecasting 1080, and you can see again a little bit of carry, but generally less than we typically see. Let's get to the last part here. So you can see 948, 4 cent under basis, 953 in Topeka, Salina, 933 Hutchinson. So soybeans, bless their hearts, have tended to have a lower cost of production. It really opens the question: what will we do next year if we maintain higher cost production for corn and the soybean cost production remains lower? Do we move even more strongly into soybeans? If so, then that ends up conversely helping the corn market way out there, but we'll see. Okay, would say that you can see the USDA's latest projection, 53.2 bushels per acre. That is, it's hard to argue one way or the other on. But in the Pro Farmer surveys came in at 54 some. So nothing looking negative for beans, probably just at risk for hot, dry weather the next few weeks as it finishes up. And you can see it pretty similar to corn. Real consistent percent good to excellent, just moving forward. Will we just, if we break like that, then the 54, 55, who knows where they'll go. Okay, we are closing slowly on soybean exports. If anything, we're going to end up what was a pretty good year with what's come on for South America. We've slowed down our pace. We could end up and have the worst year in the last several by the time we get to the end in total. Okay, just want to show you this. Then, so in terms of the, it seems to give the USDA their due on this. Again, the 53.2 bushels per acre seems to be supported by what we've seen of late. 60% chance of that. with the heat that could come on, we could see some shaving off of yields if it really gets hot and rough for more than a week or 2 or 3, down to 52, down to 50. You start taking enough off after duration usage, and you get, here your USDA's projection 1080, just down to 52, all else equal the same on usage. Shave 100 some million bushels off, 1170 price. Still, that's a moderately better price. If we go lower than expected right now, you're below 10% stocks to use, 1245. And again, you're looking at this type of set of relationships. Okay. So with that, Mark, why don't you come back on? I think you're already on there. I think we can take questions, Rich, and try to address any concerns that there are.
Sure. Yeah, folks, go ahead. If you have questions, you can put those in the chat, and I'm also going to allow you to unmute. You can go ahead and just unmute your microphone and talk to Dan and Mark at this point. Feel free to.
Yeah, Dan, I might start with a question on the corn and the soybeans. I think you were giving USDA their due, but you are also putting in there 35% chances of a pretty good little pop. I guess does that kind of, I guess from what I gather, this concept of, we actually may see, a little bit more weakness, but we may actually see prices trend up, who knows, 20, 30 cents into harvest. And is that, is your crystal ball, is that what you're seeing?
Well,
fairly good odds.
It's pretty stark to see what's happened last night. That one moisture map, the percent of moisture that went from 90 to 30 to 14 to 7, and it's dry, and it's going to get hot. So, and for soybeans, they're vulnerable. They're more vulnerable, I'd say, than corn. But again, they're coming out of August. Their primary flowering pods. Flowering pod setting, maturity mode. I think soybeans are more vulnerable. Now, it doesn't surprise me, and I'm not trying to talk the market one way or the other, but that the Pro Farmer Tour went through some pretty wet areas. Man, things look great. And so again, you've got to acknowledge that. But we also see climatologists talking about hot, dry weather for the next several weeks, and so I guess it's in my own thinking, just acknowledging, hey, we may not finish well. We may not finish as well as if we had great greenhouse weather all the way through. It looks like that's probably in question right now.
And the reason I asked that, Dan, was because I'll read these market newsletters and various things, and everybody's priced all their 2024 corn back when it was $9 a bushel or whatever, and they're all just doing awesome. But when I get out in the country,
let me ask that. Let me. Everybody that did it is talking about it. Everybody that
I'm wondering, because I get out in the country and I talk to folks, and I'm hearing a lot of people that are kind of like me. In our plan, right, we've got 10% of our corn price, not a lot. Haven't done much, and I guess that's where I'm kind of heading with my questions, because it's like, okay, so if I'm one of those folks that I haven't done much to date, it sounds like, well, let's let this kind of go, because there's as good as any chances all out there that we are going to see a little bit of a bump as we go up here into as we go through September and into October, that we could actually see prices strengthening. And so, I don't want to get, I guess today, I don't want to get into a hurry trying to do any 2024 corn or soybean pricing. I guess that's kind of where I'm headed. Let's see if we can get up and see that 33% rally, or get up to 425 December corn. And maybe at that point, we want to do something, Dan, because will that be about as good as it gets even into 2025 with those bushels?
Well, and What you just said is consistent with this winning the game type of grain marketing plans that we said. We said up front, gosh, if we're not covering cost of production pre-harvest, that we're not going to lock in a loss, and that we're going to deliberately put ourselves into harvest and then look to storage. So that's whereas last year when we had done this, man, we were just pulling the trigger. It was tremendous, but this is the other side of the coin, to where, gosh, as these prices have fallen off at the higher production costs that we had, we just didn't price in to be consistent with that plan. And so you're asking, so what happens after harvest if this comes about? Well, then my thought would be that you look at all the things that happen to a market, all the actions of producers in reaction to having an unprofitable year, and it affects their acreage, what their planning decisions are. We probably cut back on high cost crops. It probably impacts corn, and or at least our expenditures for that. And if we're cutting back on fertilizer or just tamping seed down, we're setting ourselves up for less production. So they don't say this in our schooling, but it holds true economically when you look at the underlying theory of it, that the best cure for high prices is high prices. The best cure for low prices is low prices. That's because of how people respond to them. So if we actually get into this harvest, nothing changes, we have low prices, then we'll start looking around. It's going to cause financial challenges. We'll adjust our inputs. We'll probably change our crop mix, and then we'll see where we're going. Right now, even with Mark, what was your cost of production number for soybeans again that you projected for the coming year?
You bet. Okay, for 2025, we'd be looking at, and again, these are preliminary, direct cost per bushel. So direct cost, fungicides, herbicides, diesel, fertilizer would be about $5.29 a bushel, and that's based off of a 50 bushel target yield.
But what's the total cost?
Total $9.69. And again, this would be for 2025. We were at $9.36 for 2024.
Right, and we're generally, that's closer to being within reach than the corn number is. Your corn number was 5 something, wasn't it?
For 2024, 437.
Yeah.
But I always, I had some basis and things to get a futures target, but I'm talking, so a cash price of 437 would be total. 362 would be your direct cost with cash rent added to that, as if like, hey, I'm kind of one of those guys, a lot of my ground's cash rented. You're at 362, and that's based off of a yield of 157. So again, it's the state number. It's an aggressive number, but that's what we've got there.
So nothing is covering cost. Everything's below water a little bit, but corn is more below water, relatively speaking, than soybeans. It probably pushes us towards beans. You don't have sorghum in there out to the west. Sorghum generally, it has at least lower seed, slower seed costs. So we start pushing. We start taking actions to push away from the high cost stuff. And in fact, I just within the last couple of weeks read where the Argentine farmers are moving away from. Well, there's change. These changes happen down in South America too, and one advantage we have is that we get to see what the South Americans are doing with Argentina, Brazil, Paraguay before we put our crops in. so we get to react off of them a little bit. So we're thrown into this dynamic decision-making process to where we'll try to avoid losing money again, and that itself is going to cause things to happen and probably change crop mix. Probably corn gets pressured, at least initially, more soybeans, more sorghum, and we will still grow a whole bunch of corn, but we'll economize on the cost, I think. Does that make sense to you?
Makes a lot of sense. I think so. I think, yeah, I tell you what, so many folks are set into a rotation, right? Because I think they were talking like, hey, boy, returns on wheat aren't so good, we're going to back off. Well, we can't back off on everything, but what we can back off is those as your point, some of the inputs. I'm not going to fertilize for that high target one. We're going to be a little bit more conservative. So maybe yields, that'd be one way where we maybe lower that supply. I'm trying to find the optimal yield, the optimal set of inputs and yield, as opposed to trying to max out yield. And we might see a lot of folks kind of doing that.
It brings challenging discussions in the cash rents and all sorts of things. And that happens this winter. So any other, thank you, Mark, for engaging on that.
You bet. You bet.
Folks, go ahead. If you have something, you can unmute and talk to Dan and Mark, or go ahead and drop something in the chat. We'll close things down here before long, but if we got something, we'll stick around for it.
So I think Mark and Rich, I think we have one more of these in September planned.
Yes,
and
we do.
If it's a harvest low, it might be a pretty we'll see where we go, but we'll diligently be here. In fact, what we'll be talking about then will be, do you save for post harvest? That's where we'd have to pivot if things come as they are. But again, if we turn hot and dry for 3 weeks and things change a bit, well, we'll see where we go.
And that's planned for September 23rd on Monday again at noon. So you can watch for that along the way, folks.
I want to thank Doug Bounds. Doug is with the USDA NASS, and his people are just about ready to head out into the field for those objective yield surveys, and that's going to be pretty valuable stuff this year.
Well, I'm not seeing anything else, and I'm not hearing somebody break in, so we're going to go ahead and call it a day. Thanks for being on, and we'll look forward to seeing you next month. Mark and Dan, appreciate you doing this.
Thank you, guys. Take care.